start with the basics. What exactly is a listed company? A listed company is one that's officially registered on a stock exchange, such as the BSE or NSE in India. This means its shares are available for the public to buy and sell, making it possible for anyone to become a part owner. Being listed brings transparency and regulatory oversight, which helps protect investors and ensures the company follows strict rules. Listing also allows companies to raise capital from a wide pool of investors, fueling their growth and expansion. In essence, when you hear about companies going public, this is what it means: they're joining the stock exchange and opening their doors to public investment. Now, let's break down the concept of share capital. Share capital is the money a company raises by issuing shares to investors. The total capital is divided into small units called shares, and each share represents a fraction of ownership in the company. There are several types of capital to know about. Authorized capital, which is the maximum amount a company can issue as stated in its memorandum of association. Issued capital, which is the portion actually offered to investors. And subscribed capital, which is the amount investors have agreed to buy. Subscribed capital itself can be fully subscribed, undersubscribed, or oversubscribed, depending on investor demand. These distinctions are crucial for understanding how companies manage their finances and ownership structure. Shares come in two main types: equity shares and preference shares, as defined by the Companies Act 2013. Equity shares represent true ownership. Holders get voting rights and share in the company's profits, but they also take on higher risk. Preference shares, on the other hand, are a hybrid between stocks and bonds. Owners of preference shares get priority when it comes to receiving dividends and repayment if the company closes, but usually don't have voting rights. This distinction is important for investors, as it affects both their potential returns and their influence over company decisions. Understanding these types helps you make informed choices about where to invest your money. There are several important rules and concepts every investor should know. For example, companies must achieve a minimum subscription of 90% of the total issue, or else all application money must be refunded. The maximum interest rate for calls in arrear is 10%, while calls in advance can earn up to 12%. Reserved capital is a portion of uncalled capital set aside for liquidation, and capital reserve is created from capital profits, like the sale of assets. Securities premium can be used for specific purposes, such as issuing bonus shares or writing off preliminary expenses. These rules ensure fairness and transparency in the way companies raise and manage funds. Let's wrap up with some special terms you'll often hear. Calls in arrear refer to amounts not paid by shareholders when requested by the company, while calls in advance are payments made before they're officially due. Share forfeiture happens when a shareholder fails to pay, leading to cancellation of their shares, which can then be reissued at par, premium, or discount. Bonus shares are free shares given to existing shareholders, and sweat equity shares reward employees or directors for their contributions. Finally, retained earnings are profits kept in the business for growth, rather than distributed as dividends. Knowing these terms helps you better understand company announcements and financial statements.